Banks and credit unions can offer insurance against check fraud, account takeovers, and social engineering by developing a multi-layered approach that combines both traditional financial protections and innovative solutions. Here's a breakdown of potential strategies. 1. Dedicated fraud insurance products. Check fraud protection insurance. Banks could offer insurance policies that cover losses arising from forged, altered, or counterfeit checks. This could include reimbursing customers for any losses incurred if checks were fraudulently cashed or deposited. Account takeover insurance. This type of coverage could protect customers against unauthorized transactions resulting from account takeovers. If a fraudster gains access to a customer's account through phishing or hacking, the insurance would cover any fraudulent withdrawals or transfers. Social engineering insurance. Banks could offer specialized insurance products to protect customers from losses due to social engineering attacks such as phishing, vishing, or pretexting, where fraudsters impersonate bank representatives or others to trick the customer into revealing sensitive information. 2. Enhanced fraud detection and monitoring tools. Real-time transaction monitoring. Offering customers real-time alerts and transaction monitoring to detect suspicious activities as they happen. Banks could provide insurance coverage in conjunction with these alerts where any losses due to delayed detection would be covered under the policy. Behavioral biometrics and multi-factor authentication. To reduce the risk of account takeovers, banks could implement multi-factor authentication for online banking and transaction approvals, adding insurance coverage for any losses resulting from account takeovers. Despite these security measures, could reassure customers. 3. Collaboration with third-party cybersecurity providers. Identity theft protection. Collaborating with cybersecurity companies to offer identity theft protection services as part of the bank's offerings, which could help customers detect fraud early and mitigate damage before it becomes a financial loss. Social engineering awareness programs. Offering training or partnerships with educational platforms to educate customers about social engineering tactics. This could be bundled with insurance to cover losses that occur despite the educational efforts. Transaction limits and controls. Customizable alerts and limits. Allow customers to set personal transaction limits like a daily withdrawal limit and receive real-time alerts for transactions that exceed those limits. These proactive steps combined with fraud insurance could help prevent significant losses due to unauthorized transactions. Secure digital transactions. Provide customers with encrypted payment channels or virtual accounts, such as one-time use virtual cards for online transactions, reducing the risk of fraud or misuse. Coverage for losses incurred via these virtual channels could be offered as part of the insurance policy. Claims reimbursement with conditional coverage. Coverage for insured transactions. Banks could offer an opt-in fraud protection policy, where customers are covered for financial losses, only if they follow certain security protocols, like enabling multi-factor authentication, using strong passwords, and immediately reporting suspicious activity. This reduces risk for the bank, while still providing meaningful coverage for customers. Conditional coverage for account access. For high-risk customers, such as those managing large sums or frequent international transactions, banks could require additional security measures like biometric verification or PIN and password resets, and offer a tiered insurance policy based on compliance with these protocols. Blockchain-based security solutions. Smart contract-based fraud prevention. Banks could explore blockchain technologies for securing checks and account transactions. By using blockchain's transparency and immutability, banks could offer customers a more secure method of validating the authenticity of checks or transfers. Fraud insurance could cover the costs of loss due to blockchain vulnerabilities, if any, or exploitation of the system by external parties. Collaboration with insurance companies. Banks could partner with insurance companies to offer specialized fraud insurance coverage as part of a comprehensive financial protection package. By leveraging existing insurance infrastructure, banks can provide more robust and reliable fraud protection for customers while streamlining the claims process. Post-incident recovery and support. Fraud recovery assistance. Beyond just offering financial compensation, banks could provide services to help customers recover from the emotional and administrative burdens of fraud, such as identity restoration services, legal consultations, and credit monitoring. Liability coverage. Insurance could cover customers in situations where they are found to be partially at fault, such as in cases where they unknowingly give up information during a social engineering attack. This would reduce customer frustration and increase trust in the bank's commitment to protecting them. By offering these types of products and services, banks and credit unions can not only enhance their customers' security, but also create a competitive advantage. Customers would likely appreciate knowing that their financial institutions are taking proactive steps to safeguard their accounts and provide recourse in the event of a fraud incident. This approach combines innovation with security, offering a comprehensive solution that addresses both prevention and recovery.